In this video, I'll be sharing a simple yet profitable smart money trading strategy. This trading strategy was utilized by Richard Wyckoff, one of the greatest traders in history. If you search online, you'll come across numerous blog posts about him, but very few explain the strategy in a straightforward manner. That's because many who discuss it don't truly grasp it or even implement it themselves. So, if you're keen on adopting Richard Wyckoff's trading strategy and viewing the market through the lens of a seasoned trader, I highly recommend watching this video until the end. Richard Wyckoff divides the market into 4 stages: accumulation stage, advancing stage, distribution stage, declining stage. Let me explain. Accumulation stage. In this phase, the market is characterized by relatively low volatility and a lack of clear trend or direction. Prices may move within a range or consolidate in a sideways pattern. Traders may use range-bound strategies, such as support and resistance levels, to identify potential entry and exit points. Advancing stage. Once a breakout occurs, the market may enter a trending phase, characterized by a sustained movement in a particular direction. Trends can be bullish, bearish, or sideways. Traders may use various trend following strategies and technical indicators to identify and participate in trending markets. Distribution phase. The distribution phase begins as sellers take profits and charts fail to make new higher highs and begin to go sideways. Profit-taking dominates this part of the cycle as charts reach their peak and bearish chart patterns form like the head and shoulders or a double top. Doubt is the primary thinking during this phase. Downtrend phase. The downtrend phase occurs when the price on the chart is making lower highs and lower lows due to relentless selling pressure. This is the phase where stop losses are triggered, causing lower and lower prices, and rallies fail to go higher and are used as selling opportunities for holders. Fear is the primary emotion during this phase. When you open your chart, you should be able to identify these market stages. Remember, an accumulation phase occurs after an extended downtrend, while a distribution phase occurs after an extended uptrend. When the market enters an accumulation phase or consolidation, this is where institutional investors often begin to manipulate the market. One of the strategies identified by Richard Wyckoff is that the market undergoes clear manipulation during the accumulation phase, before reversing and experiencing a strong upward movement. This manipulation is referred to as the spring pattern. A spring in trading occurs when the price sharply drops below a certain level of support, tricking sellers into believing a new downtrend is starting. However, the price quickly reverses and closes back above that support level. This sudden reversal catches those sellers off guard, triggering their stop losses and causing them to lose money. Meanwhile, institutional traders recognize this trap and enter the market heavily, leading to a strong upward movement. So in essence, a spring is like a false breakout designed to trap sellers before a significant upward move. To trade the spring pattern effectively, start by identifying an accumulation phase or a ranging market. Wait for the false breakout at the support level. On the chart, you'll see the market breaking below support and then closing back inside the range. This clear false breakout is your signal. Place your entry at the close of the candle that closed inside the range, with a stop loss placed just below the last candle, and aim for the next level as your target. Here's another example. The market breaks below support, creating a breakout trap, and then reverses to close inside the range again. In this case, place your entry at the close of the breakout candle, set your stop loss just below it, and target the next level. This strategy tends to be profitable because your risk is typically smaller than your reward when the market moves in your favor. But what if you miss the spring pattern and the market closes inside the range? Don't worry. Simply wait for the market to break out of the range and then pull back. For instance, if the market breaks below support and then reverses inside the range, but you miss the initial trade, wait for the market to break above the resistance level. Then, look for a pullback. Enter at the pullback, set your stop loss below the pullback candle, and aim for a reward that's at least twice the size of your risk. Sometimes you might miss the spring pattern altogether, and the market breaks above the resistance level without giving you a chance to enter on the pullback. Don't be discouraged. This is part of trading. It's not an exact science. Sometimes pullbacks happen, and sometimes they don't. When they do, you can enter the market. But when they don't, it's best to stay out. Remember, your goal in trading is not just to be in the market, it's to win. And to win, you need to focus on high probability trading setups. The second strategy identified by Richard Wyckoff is the upthrust trading strategy. An upthrust occurs when the price sharply breaks above the trading range before quickly reversing and closing below the violated resistance. This false breakout traps buyers who believe the market will continue to rise, but instead, the market closes back inside the range and reverses its trend. Take a look at this chart example. The market was trending upwards, then it started ranging, forming a nice distribution phase. Here, you should wait for a false breakout to happen at the resistance level. Once the false breakout occurs, enter at the close of the candle that made the breakout, place a stop loss above it, and target the next level. Let's take another example. Here, the market was trading sideways, with clear candlestick patterns breaking through resistance and then reversing within the range, forming a breakout trap, also known as an upthrust. In this scenario, buyers found themselves trapped by sellers. What you should do is enter immediately at the close of the candle that made the breakout, set a stop loss above the candle, and target the next level. But what if you miss this breakout trap? If you miss this trading opportunity, simply wait for a pullback, which frequently occurs after a range breakout. So why wait for a pullback? Waiting for a pullback is essential because you're unsure of the intentions of the major players. Will they push through the support and reverse the market trend, or will they keep the market within this range? So it's best to wait for the breakout and then wait for a pullback. The pullback acts as another opportunity provided by the major players to join the new downward trend. Let me provide an example. In this scenario, the market clearly made an upthrust, broke through the support level, and then pulled back. Your best entry point would be during the pullback if you missed the upthrust. Remember, sometimes the pullback doesn't occur, but don't let that discourage you. The market is abundant, and there will always be great trading opportunities available. The spring and upthrust trading strategy works on all time frames and in all financial markets. So whether you trade Forex, the stock market, or cryptocurrencies, this strategy is for you. All you need is some screen time and practice to master it. I hope this video has taught you something new. Don't forget to like and subscribe to the channel for more videos. Thank you for watching and see you soon.